welcome back, everyone, and we're very glad that you could join us. This is a continuation of Credit Suisse's FinTech conference, and I'm Moshe Orenbuch. I cover the specialty finance sector, and lead the FinTech effort globally. And we're very pleased to have with us Jifiti. Jifiti is a company with whom we actually did an event earlier in the year, and very intriguing business, which you'll hear about in a few moments. Basically, Jifiti was founded in 2010 by our presenter, Yaacov Martin, and his chief marketing officer, Shaul Weisband, and with backgrounds in retail and marketing, developed a solution for banks who want a BNPL program pretty much on a turnkey basis, very little integration. They have a number of significant clients in the US and Europe. And we'll talk about that because of the interesting and timely nature of how important BNPL has become, and the steps I think that the banking industry is taking to either live alongside it or to compete with it. So with that, Yaacov, welcome, and thanks for joining us.
Thank you for having me.
Great. Maybe just start out, and I gave a very, very brief description of the company. Maybe kind of flesh that out a little bit. Tell us, about what kind of prompted you to start the company, and what it's trying to accomplish.
Sure. So we actually went through quite an interesting evolutionary process. When we founded the company early on, I think you said 2010, it was right around there, maybe a year later, but who's counting today already, right? We were looking to provide various solutions around checkout and point of sale. At the time, we weren't even looking at BNPL, or buy now, pay later. We were looking at providing various gifting platforms. And what we found very early on was that any type of partnership between any type of party and a retailer, a merchant, would generally include this very heavy type of task of integrating with the merchant's point of sale. And that integration requirement was one that we saw that killed many different opportunities, many different deals. And the reason is because point of sale, definitely in store, is quite often built on legacy systems with third parties, and any type of integration could be expensive and very, very long. So we look to ease that type of process and build on top of all sorts of existing infrastructures that existed at point of sale in order to enable partnerships. At the time, of course, we were trying to serve ourselves and allow for us to launch these various gifting platforms. But we ended up becoming more of an infrastructure company rather than a lifestyle company. And about 3 years ago, we figured out that much of what we built on the infrastructure layer can really serve as a perfect solution for connecting financial institutions and merchants to offer various credit products at the point of sale.
And, you talked about some of your partners. And could you just talk a little bit about, the way in which those partners kind of use Jifiti to the market?
Sure. So really our partners can be divided into two. We have partners on the banking side, and then we have partners on the merchant side. Now, of course, for any type of BNPL product or point of sale finance product, eventually there's a need for both parties to collaborate. You need a bank or a lender on the one side and a merchant who is looking to distribute this credit solution to its consumers on the other end. But when I speak about these two categories, we really do have different types of partnerships, sometimes driven by the financial institution, meaning in which case we provide the financial institution with infrastructure and a platform to offer point of sale finance or buy now, pay later products. And then there are other instances, I would say, particularly with global merchants, where the global merchant partners with us in order for us to become their global enabler. As you can imagine, all of these partnerships and all of these offerings, regardless of which market they're taking place in, require quite a bit of work. And instead of the merchant, for example, a global merchant having to go through a bespoke integration with every single local bank they decide to use, they're able to use our platform as their uniform platform and have any type of lender, bank, financial institution connect into the platform instead of having to directly integrate with all of their systems.
Gotcha. And I know you've used some examples in the past, of certainly of the bank partners. I mean, are there any that you would be willing to share with us as and how they've integrated the solution?
So instead of actually zooming into any particulars, and we can definitely mention some of the ones that are public a little bit later on, I would say that what we look for in a banking partner is usually a bank which is already active in the space, or at least has what we call the core component or bank competencies in order to be active in the space. So I'll just give an example. We work with Citizens Bank is a great partner of ours, as well as, for example, working with Credit Agricole out of Paris, France. These banks are all banks who have been leaders in their space. And the partnerships that we've created with these banks are really there in order to scale the business, in order to be able to launch various point of sale finance and buy now pay later products at scale. What I always like positioning one next to another are the great things that some of these banks have done in the space, and on the other hand, some of the great things that the fintechs have done in the space. When we really look at some of the brands that we've been hearing about quite a bit over the last 2 years, Affirm, Klarna, Afterpay, etc., one cannot ignore the success they've had in terms of deployment and distribution. These guys have really learned or taught the market, I would say, in a way, how one can onboard not a single merchants per year or tens of merchants per year, but sometimes hundreds and even thousands of merchants per year. Now, granted, they focused on a segment of the industry. I mean, they started with online. Some of them have some in-store solutions. Online is, I would say, a whole lot easier than in-store integration. But that piece of the business, they've done spectacularly well. And in a way, what we are doing with our banking partners is enabling them to reach scale.
Got it. Well, that makes a lot of sense. And when I talk to investors about the buy now pay later players, the Affirms, the Klarnas, and Afterpays, that's what I say to them. The technology advantage is not so much in the providing of the credit to the consumer, although there are technology aspects to it. It's in the ability to onboard and manage those merchant relationships. As you point out, clearly easier to do in the online space. And so a couple of different areas to kind of branch out from that set of statements. I guess one is, is you're kind of in a unique position to see how leaders within the banking industry, consumer finance leaders are thinking about, buy now, pay later, or point of sale finance, maybe a little more broadly at this stage. And, kind of any thoughts that you'd share with the group here as to how the industry is thinking about it, and maybe perhaps, how they should be thinking about it.
Right. And I think obviously, much of this comes on the back of some consolidation that we've heard about recently. And I think to a great degree, that is maybe the first very, very large scale play. And I think it's only the beginning of what we're, in my opinion, at least going to see in the market. And it's not only consolidation. Consolidation sounds often like one entity swallowing up another. And I don't think that is what's going on. I think that there is a true type of partnership wave. We definitely see this in our business, where many of our clients, mostly on the lending side, are much, much more open to partnering with other lenders and other buy now, pay later providers. And if once upon a time we felt that everybody was going head to head, everybody was trying to gain market share, I think as this segment matures, what we're finding is that the various players are really understanding where they play best and where they don't. And therefore, some of what I think we're going to see more and more of are these frenemy type of relationships, where various lenders, both fintechs and traditional, are able to lock hands and decide to offer a much, much broader and richer spectrum of credit products. So that's definitely one direction that I think we're going to be seeing the market going in. There is another one, you may be touching on it later on, so I definitely don't want to cover it now in that case, but I'll just mention it. And that is what's going to happen from a regulatory standpoint. How is the regulator going to start implementing certain guidelines and requirements, and how is that going to change the landscape? And in that respect, obviously we view our banking clients and prospects and those that we are in processes in very, very well positioned to be able to deliver a day after many of those regulations and regulatory requirements come in, and they will.
Yeah, I think we will touch on that a little bit later, particularly if there is time. But I wanted to come back to something else that you had said, and that was, that the obviously the bulk of what is considered buy now, pay later is actually kind of an e-commerce solution. Can you talk a little bit about how your solution kind of enables this, on the in-store side, which is still obviously the dominant part of overall commerce globally?
Yeah. So as I mentioned before, I think the plain reason that these buy now, pay later products have flourished first in the online sphere and only then started to tackle the in-store is, number one, because of the ease of integration or relative ease of integration online. You essentially, all you have to do in theory is place some sort of button somewhere along the user journey in order to take them into some sort of application mode, loan application or credit application mode. Obviously, with some of the giants online, shopping cart giants like Shopify, Magento, and so on and so forth, if you are going for that segment of the market, then you can again very easily provide that type of widget or integration point through the shopping cart itself. So there's a technical element that has definitely dictated the fact that this market first and foremost flourished online. The second one is also because of something that I think you hinted at, and that is the type of purchases that generally take place online, as opposed to those that are still, I would say over 90% of those sales are taking place in store. And those are large ticket and small ticket. So very large ticket items, yes, of course, every year that goes by, we see more and more of those taking place online as well. And there are many, many exceptions. But if you look at the general numbers, we're still seeing the vast majority of furniture shopping, for example, taking place in store. And once again, that large ticket and longer duration type of loans that are expected generally are executed in the best way possible by the traditional banks who have that type of balance sheet, who have that type of experience and history in underwriting and credit decisioning. And there, of course, our job as a platform, as an enabler, as a facilitator, is to make it, on the one hand, very, very accessible to the merchants. So the merchants don't have to say, okay, I'm now reliant on my point of sale company, my gateway, my terminals, whatever it may be. So eliminate some of those dependencies. And on the other hand, make it extremely accessible to their consumers who are browsing the store and have to find out about it. We call it the discovery phase. either before they step into the store or as soon as possible after they step into the store.
Oh, sorry, I forgot to unmute. So the other thing I wanted to ask you is that maybe you could talk just for a minute about your profitability model. How is Jifiti compensated in these arrangements? And then we'll kind of build off that a little bit.
Sure. Generally speaking, we make a piece of whatever transaction we facilitate. So it's not based on the application volume or even on the approved loan volume, but rather only transactions that we facilitate. The reason that we've always married those two is because a big piece of what we do today in our business is not only the user journey, which is obviously very important, something that we provide both in store and online in a white labeled fashion, of course, but I would say from a FinTech standpoint, the more interesting piece, I believe, is the disbursement of the funds, meaning how once the user has completed the user application, the bank or the lender have rendered their credit decision, the consumer has signed off on the terms and conditions, of course, digitally. This can take place on their own device. This takes place on the website if they're online, whatever it may be. How do these funds that have just been approved get transferred over in real time to the merchant? How does that transaction get closed out? And how is the merchant really, and I think this is the most important, how is the merchant able to focus on business as usual? We don't want to have to train employees. We don't want to have to train coworkers. That is quite a task, especially if we're working with a global merchant. And therefore, the disbursement of the funds and the way we close out the transaction is really, I think, maybe one of the most important components that we provide today. And therefore, our business economics are tied into that.
Gotcha. And effectively, you're referring to interchange. What's interesting about your business is you operate. You have major clients. You've said both in the U.S. and in Europe. Are there differences in the way the business works in high interchange and low interchange markets, or is it comparable?
Yeah, so interchange is definitely one of the components because our modes of disbursement are many, meaning virtual card is definitely one of them. And virtual cards, for example, on the one hand, have this tremendous advantage where they're riding off the networks. And therefore, as far as everyone is concerned, it's just a card transaction. Nobody really cares how this card or virtual card in this case has been funded. And it allows us to launch both in-store and online without any integration, essentially, to any of the payment gateways or acquirers, et cetera. It is only one of 5 different methods of disbursement that we utilize today. But as you mentioned, the usage of this virtual card is often dictated by the commercials as well. So commercials together with level of effort of integration. So interchange in the US is very different to interchange in Europe. So in Europe, generally, the virtual card doesn't really come together with what we are used to, at least in the US, in terms of an interchange rate. There is interchange, but it is regulated and capped at about 20 basis points, so not really a big concern for anyone. On the other hand, I must say that in the US as well, we found this to be an incredible solution in certain segments of the market where the cost of card transactions are already built into the margins, and the ease of launch or the speed of launch is really a first priority.
Gotcha. Okay, I should mention to the audience that if you do have questions, you can click, I think, on my email address, and it'll open up an email form to send that question in, and I will work it in here. Yaacov, you had mentioned that you also kind of work not just on the issuer side, but on the merchant side. Maybe kind of, tell us a little more about that and how it works. You mentioned for some large global merchants.
Sure. So in a way, the global merchants have a very similar need or even challenge, I would say, to some of the banks that we work with. In the same way that the banks are looking to scale on the merchant side, and not looking for a bespoke or customized integration with every single merchant that they onboard, so too these global merchants are not looking for a customized or bespoke integration with every bank that they choose to work with in every one of their markets. So in many ways, those type of relationships are very, very similar. And of course, I probably don't have to say this to your audience, but working with larger organizations require a certain type, I would almost say, of DNA of a company, especially a tech company. And what we generally look to do, or maybe this is what we know how to do, and we don't necessarily, I always say about myself, I don't necessarily know how to build one of these massive sales team that sells a SaaS product for sub $99 a month and ring a bell every time they make a sale. What we know how to do as a team is forge relationships with larger organizations, longer sales cycles, but a true and deep partnership, a great deal of loyalty, of alignment. And essentially, we really try to understand the specific needs of these global merchants. So some of those have to do with, like I said, the various markets that they operate in. Others have to do with really the values of their brand and how those are reflected, especially in a credit program. So we have a bunch of brands that we work with, and I can think of one in particular that is extremely conscientious of its consumers' well-being, not overextending themselves on the one hand, but on the other hand, really giving them a quality of life at an affordable price. So of course, that plays a part in the way that we design the entire user flow or user journey with them. So on the one hand, you don't want to create friction, you want it to be streamlined. On the other hand, you want to ensure that it is responsible and make sure that the customers are applying for loans in a responsible manner and not overextending themselves. And that's something we can also speak about in the context of regulations and regulatory framework. I think you're on mute, Moshe.
Thank you. Given that you did bring that up, let's go there right now. I think there's been a little bit of greater degree of regulatory attention both in the UK and in Australia, where buy now, pay later has been around for a longer period of time. And then some kind of early stage discussions of it. What do you see, particularly for the US, regulatory issues?
Yeah, so I think the U.
Might have frozen there for a second.
Okay, I think we should be okay. All
yeah,
good now?
Very good.
Okay. Sorry about that.
Yes.
So I think that the US is not fundamentally different to any one of the other markets. The beauty of buy now, pay later is the fact that it's not regulated. And the danger of buy now, pay later is the fact that it's not regulated. Because what it does is it allows consumers to amass a great deal of debt, and it doesn't really give any tools whatsoever to the regulator to monitor the buildup of this debt. When companies are able to promote themselves by the fact that they don't have to run a credit check, or that the loan or buy now, pay later product that is being extended to its customers do not register with the credit bureau, we obviously can understand that that's great if you are desperate as a consumer to walk out with this item in hand, but it's not really great when you take a more responsible look at the general population and the general debt situation. So what is happening in the UK, what is happening in Australia, at least in our mind, is going to extend to the rest of the world in one shape or form, and that includes the United States. That does not mean that the buy now, pay later companies will cease to exist. It will mean, in my opinion, that the buy now, pay later companies will have to apply some practices that will allow for this responsible lending or responsible debt. And like I said, I believe that this is the reason that in the long term, the regulated banks and financial institutions are very well positioned to lead this category. And I know that it's not necessarily looked at that way today.
It's interesting because clearly there were other potential bidders for Afterpay in addition to Square. Reportedly at least one of them was a financial institution, and maybe a $30 billion price tag is large for a financial institution, but there are smaller buy now, pay later companies. And, Bread was sold to Alliance Data. So you've got an example of one that actually has happened. Discover has an ownership position in Sezzle. So there, it's a minority stake, but a stake nonetheless. And so there certainly are likely or potential other kind of link ups. And I guess what I would ask you is, does buy now, pay later kind of exist? Do you think it exists better as kind of one of a set of payment options, or, can it continue to exist as kind of a standalone thing where, here I am, I'm a company and I do buy now, pay later solutions?
Right. So the answer is it can continue existing as a standalone, but it will require a great deal of change from these standalone companies. And some of them, I think, will undergo change. And they'll survive that change, and I think others will not. Others will, just one way or another, either get swallowed up or cease to exist. And what we've been saying for a while, and as time goes on, I think we believe in it more and more, is that the winning combination is really the forging these partnerships between traditional financial institutions and technology fintechs. And one of the things that I always say when I have to give a pitch is I like starting off with what we don't do as opposed to what we do. And I always speak about the fact that when we're referred to as a buy now, pay later company, or as a point of sale finance or fintech, it's very important to note that we don't lend. We don't even underwrite, because we don't believe that we are best positioned to do those things. We still believe that our banking partners, who have amassed a great deal of experience in the field, sometimes over 100 years, have a balance sheet that is healthier than any other fintech lender that at least I'm aware of, has a much more efficient cost of capital. They are well positioned to ultimately win this marathon, maybe not the sprint, but the marathon. And what we have to do with them is ensure that the user journey is seamless, that the distribution can take place at scale. So that's what we really expect to see. We expect to see those who have forged deep partnerships with fintechs, meaning the banks that have forged deep partnerships with fintechs, and not only on an opportunistic level, but really with a vision. We expect them to come out on top at the end of the day.
Gotcha. And if, that's kind of a great kind of, approach to think about it over a multi-year basis. What about if we're thinking about it kind of on the more intermediate term? What changes do you think we see, from the large financial institutions? Do you see more of them? Because, so far, most of what we've seen is just going after your existing like credit card customers with a split pay type of 10 or 12 payments out of your carve out these transactions, but that's kind of an after the fact type of solution. Do you see obviously you've got your customers, but do you see it kind of as a trend that we're going to start seeing more of in the near term, of financial institutions kind of pushing out at the point of sale to a greater degree?
Absolutely. If I were to even compare what I hear on certain calls or see-through processes today as to what I saw 6 months ago and 12 months ago, it's almost incomparable. 12 months ago, when we started a process with any bank or lender, you basically started off where everyone used to start off, which is buy, build, or partner. One of the things that I've noticed today is that for the larger financial institutions, the build is off the table. They're not even considering it because they've seen the speed at which these companies have moved at, and the industry as a whole has moved at. So that's number one. Number two is, in the past, we've seen many banks and financial institutions or lenders, I would say primarily banks and financial institutions, settle with kind of a post-transaction offering, as you mentioned, Moshe, meaning the ability to split your transaction post facto. And often that kind of gave them the feeling that they were doing something and they don't necessarily have to look further. And that too has changed. All of these banks today understand that they have to get out in front of the end user, the consumer, a lot earlier on in the process. And just offering to split payment after the transaction has taken place is not going to cut it. So those are two major differences that we've seen in terms of approach.
Yeah, I think it's very, very interesting. And I think, it kind of dovetails to what you had mentioned on the regulatory front, which is, there are many more ways to split your transactions and your payments. Maybe that's going to be the function of the bank, is to help you kind of keep track of all of that at some point, which is kind of a different topic. And some of the other companies that we had at the conference are providers in that area. But I think it's kind of an interesting dynamic that the technology has certainly allowed that, and it certainly has. I think that it's kind of removes some types of transactions from the traditional market, and then the question is, can they kind of pull it back in some other way? I would say that we've gone through basically the questions that I had. Any kind of anything that I didn't ask about that you would want to bring up, or any kind of closing comments, and I'll turn it over to you, Yaacov.
So maybe in two different areas. One is actually something that you just hinted at, I believe, almost in your closing words, and that is with regard to this situation today, where a consumer who maybe until not long ago only had a commercial or financial relationship with their bank where they held their checking account, and they would look to them until not long ago to provide them with solutions around credit, around finance, around larger transactions. Today, what you're saying is basically you can end up at point of sale, and all of a sudden you have, whether you meant to forge a long-term relationship or not, you've created many, many different endpoints and many different types of relationships with various banks, FinTechs, other type of lenders. And I think that this is at the core of what is really driving some of the larger players in the industry not to give up and to figure out how they recoup a big piece of this market. Because those FinTechs and other players who have entered the market are not only providing a one-off transaction, it's not a one-off relationship either. They are forging long-term relationships with these consumers. And of course, you can only imagine how much this played a part in the last very large transaction that we've heard about between Square and Afterpay. And this is, I think, a great driver for the banks to really make sure that they are there when their consumers need them most, or that they are there when a prospect, a new potential consumer is looking for solutions. So it really is only the beginning of a process and not the end of the process by extending that buy now, pay later or consumer finance facility. I think that's one major piece that is in the background constantly and driving and motivating many of these players to really put their money where their mouth is and go after this market. And we very much enjoy working with those banks and financial institutions with that mindset and that understanding, because there are many, many things that they can do, I think, a whole lot better than some of the other players out there, both in terms of price, in terms of, like I said, responsible lending. I think that's something that banks have to constantly harp on, constantly making their balance sheet on the one hand available, but in a very, very competitive and responsible manner to both merchants and their consumers. And at the end of the day, bad debt is not good for anyone. So that's one big piece. And I think the other one is really something that you also mentioned earlier on, and that is our whole international play. We, as a smaller FinTech or facilitator, were questioned many, many times as to why we ever branched out of the US, meaning why are we not solely focusing on the US? The US is a very big market for us. But as you mentioned before, today, I would say almost 50% of what we do takes place in Europe. And I personally was questioned many, many times by partners and other colleagues as to why we were willing to invest already a year or 2 years ago in expanding into Europe. And my answer was because it's a challenge. Because Europe was a very, very interesting challenge. Every single one of those markets has its own set of rules. And despite being part of a larger EU, we still had to figure out how to be able to expand rapidly from market to market to market, something that I think many other players have shied away from. And today we're seeing that pay off. Today we're seeing how these pan-European merchants, banks, are really utilizing the platform that we built. And this is something that we expect to continue doing outside of Europe as well, to serve our global partners on both sides, on the banking sides and on the retail side, to provide them with a platform and an infrastructure that they can rely on as they look to extend their offerings across these many, many markets.
Well, perfect. And I would say, thank you to you for giving us, the insights into Jifiti, but even more so kind of the industry insights. And I hope to continue our conversations and continue to learn more over time. So thanks very much. And thank you all for participating.
Thank you.